All right, Renee, I think we can go ahead and get started.
Okay, great. Thank you for standing by and welcome to the AFS Best Practices Weekly Webinar. Our topic is COVID-19 Impact on Commercial Lending. This webinar will be approximately an hour long, and I'd like to introduce our first speaker today, Dean Snyder, Managing Director, AFSVision. To enable open dialogue, we will be unmuting lines after our prepared remarks. To help us manage those, we would like to ask that you to ask a question or to make a comment, we ask that you use the raise the hand feature. Additionally, we also have the Q&A feature that you may ask questions. Direct your questions to the presenter, and we will leave some time at the end of the presentation so we may answer as many questions as possible. We are recording today's session, so tomorrow we will send you an email so that you can listen or download the presentation. Thank you for joining us today. Dean?
Thank you, Renee, and to all of our attendees today, to your family, friends, and coworkers. Know that you all are in our thoughts and prayers here at AFS as we go through this extraordinary time. So what we would like to do today is continue discussing the CARES Act and the loan program that was introduced over the past week. We can update you on things happening here at AFS, and would love to hear from you as well in terms of your experiences and things you might be willing to share or questions that you might have for AFS. We also will continue discussion on payment deferments and forbearance updates that you're making to your existing loans, and then talk about any new topics and next steps as we continue. Again, we're looking for this to be interactive now. I've listed some of the key people from AFS who are on the line and are able to participate depending on the questions and the topics that come up. This week specifically, we've added Doug Skinner to our roster, Doug, of course, is our Director of regulatory compliance and is going to provide us an update, and again can also answer some of your questions in that area. So first we will hear an update from Lee Kidder. Last week Lee talked about the CARES Act and did a review of the key provisions, especially around the PPP program. And as I said, since last Wednesday's webinar, obviously a lot has happened in this area. So Lee, I'm going to turn it over to you. You've got some key talking points here on this slide.
Okay, Dean, thanks very, very much. And for those listening, I just want to give a quick update in the next few minutes on the PPP program primarily, and provide any statistical or other information that I've been able to glean. There have been no official progress bulletins or stats issued by the SBA. So what I'm going to talk about is really a lot of the aggregated news that we've been able to gather from many news sources over the last several days. It's been a rough first few days, as you all probably know, to say the least. This was an emergency program. It was enacted very quickly, and so problems in implementation and execution are not surprising. That said, however, there have been quite a lot of them involving system outages at both banks and the SBA, some last-minute rule changes in implementation, quite a lot of process confusion about what documentation is required, how things work, etc. And obviously delays resulting from all of those have hampered the first few days, while on many sides, gaps and process lags are being addressed on the fly. I'm sure you've all seen many of the television and media stories about these problems. I don't need or don't really want to elaborate on them. Many of the anecdotal interviews and stories that you've seen, I'm certain are happening to a lot of people and a lot of banks. How representative they are of the entire country is really anyone's guess. Banks everywhere are reporting an overwhelming number of requests and applications from small business. Although businesses have expressed a lot of frustration and resentment in some respects about, among other things, lender participation. We've heard stories of businesses contacting banks that are not yet authorized to provide 7A program participation. Eligibility preferences that a number of banks, especially the larger ones, have put in place to give preference to their existing customers. In some cases, they were preferring customers with credit histories. In other cases, they were letting customers in with only deposit relationships. So confusion was resulting from that, as well as requirements about what documentation was really needed from banks and how much had to be turned in. One of the more interesting rule changes that took place over the first several days that has caused quite a lot of frustration and resentment on the part of small businesses is the rule that for any amounts that are forgiven for these loans, 75% of that amount has to be payroll related. That has caused confusion in small businesses who think that if they have higher amounts for rent, utilities, and mortgage interest than they have payroll costs, that those loans aren't going to be forgiven. And in some cases, they're worried that those loans may not even be accepted or approved. But as I mentioned a minute ago, the number of applications that have been submitted has been overwhelming. Bank of America yesterday reported that they have received 250,000 applications totaling $40 billion. JP Morgan Chase has 375,000 for the same amount of $40 billion. Those loans range from, those applications rather, range from 4,000 to $2.6 million. And I just noticed about a half hour ago that Wells Fargo has had its asset cap that was imposed by the Fed lifted temporarily for purposes of being able to provide more loans for this program. So that's good news for them. The, the system outages and other limitations that we've been hearing about and reading about are at both ends of the pipe, if you will. The E-Tran system at SBA has experienced a number of outages. It's worth remembering that that system in any given year usually involves only about 60,000 loans totaling $30 billion. It's now being asked to ingest and support about 10 times that number. So a number of problems on that side. Technical difficulties are being reported, access limitations where only certain individuals at banks have authorized access to enter data to E-Tran, so that's limiting the scale of their ability to input information and update bank information. And then as a result, slow responsiveness. We've seen reports of bank systems that are stopping or freezing or collapsing in the midst of application. So these problems are affecting both sides of that. From what we've been able to see, there really are two major process gaps that are occurring frequently, if not regularly. Well, the first gap involves moving applications from banks to the SBA. Because of access and slow responsiveness issues that I've mentioned already, it's taking quite a while for banks to get these updated. I saw one report that quoted a bank saying that it was taking upwards of 45 minutes to enter data for any one loan. So given the thousands of loans, applications that banks are receiving, there are long delays in that. The second major gap in the process is that after loans have been approved and noted by the SBA, is getting funds dispersed to the banks. To the businesses from the banks. We've seen reports that a large number of loans have been approved. However, we're hearing from businesses that are being quoted and interviewed on the media that they don't have their money and they don't know when they're going to be able to get it. Banks, a number of banks are protesting that they are waiting from the SBA to get promissory notes executed and approved before they want to be willing to disperse the funds. And so that's holding up further delays as well. So as of yesterday afternoon, the latest information we've been able to see, there are now about 2,400 lenders across the country that are able to participate in the PPP program. That's up by 30% more than it was on Friday last week. The SBA has said to CNBC that they have assigned loan numbers to over 200,000 loans. This is the necessary step before banks can disperse the funds, and that these loans approved totaled $66 billion. So that's about 1/5 of the grand total of the original $349 billion that was appropriated by Congress for the program. So as a result of this very rapid, very voluminous activity, there are cries from literally all quarters that money is likely to run out for this program pretty quickly. I saw reports that June 1st, I think, is what the Treasury is projecting before this money will become unavailable. So the Fed is taking a step to provide a new financing facility that you may have been reading about, where they will purchase PPP loans through this facility from banks to be able to free them to make more loans so that it won't tie up more capital on their balance sheets. There are more details of that facility that are supposed to be distributed later on this week. On the other side, however, we've been hearing in the past 24 hours that both the administration and leaders in Congress, both Republican and Democrat, are pretty much unanimous in agreeing that there needs to be about $250 billion more in additional aid for the PPP program. So the U.S. Senate has scheduled a vote tomorrow on approving this bill that's being hurriedly put together today. The administration officially sent its request for that amount to Congress last night. And so that should be enacted fairly quickly. The Senate and the House are both planning to approve this aid by voice vote, which means that they don't have to come back to Congress in person to vote. So that unless any one member objects to the vote, which probably isn't going to happen, a lot of arm twisting will take place, this will be enacted fairly quickly. Now, over and above this additional aid, there are also discussions taking place in Congress and with the White House and the Treasury Department to provide yet another large supplement to the CARES Act that's being called Phase 4. There are large amounts of money that are being talked about on which side of the aisle, and new restrictions and other projections for this aid are being included in that conversation. Now, just this morning, Secretary Mnuchin of the Treasury Department had an interview with CNBC in which he said that small businesses shouldn't worry, that, quote, we will not run out of money for this PPP program. So on that pretty optimistic note, Dean, I'm going to turn it back to you, and I'll be available for any questions people have.
All right, thanks, Lee, and thanks for noting some of the challenges for the rollout of this program. We are hearing, of course, that these challenges are being dealt with and things are starting to move, which means certainly you're going to start feeling more of the impact when we get into the loan booking. Also, as I mentioned, Doug Skinner was going to join today. I think, Doug, you had an update based on this recent interagency statement. Doug, are you there to give us this update?
I am, Dean.
Thanks.
Sure. So this was actually just yesterday afternoon. The federal bank regulatory agencies, so the Fed, OCC, FDIC, and so on, working with actually working with state financial regulators this time, issued a revised statement concerning how loan modifications are going to work for borrowers that are affected by COVID-19. They had initially put out a statement a couple weeks ago. I think it was around March 20th, 22nd. But then with the passage of the CARES Act just a few days later, they had some reconciliations to do. And I'm sure this won't be the last one. So I wanted to briefly review the highlights of yesterday's statement and how we see it affecting certain accounting and reporting aspects of your businesses. So one of the main takeaways is that the regulators have instructed their examiners to exercise judgment in reviewing loan modifications that are going to be made for borrowers affected by COVID-19. They do this from time to time, such as in the case if you see a natural disaster like a hurricane, but rarely do you see it applied on a national scale. It's usually just for banks that are in a particular region of the country. The way to think about it is under normal conditions, loan modifications are typically red flags to a bank examiner or an auditor. It's a sign that a borrower is experiencing difficulty meeting the terms of the loan, and perhaps the bank should be taking some sort of corrective action. That might include, reversing interest, placing it on non-accrual, maybe increasing the loan loss provision, maybe even charging off a portion of the loan. So in this statement yesterday, the regulators have instructed the examiners to not criticize what they call prudent efforts to modify terms on existing loans to borrowers affected by COVID-19. So that would also include, for example, not automatically assigning the loan an adverse risk rating. So meaning not automatically downgrading loans to special mention or substandard or worse than that. So the agencies have actually, in several public statements, actually been encouraging the banks to work with borrowers affected by the virus and have pledged to not criticize them for doing so if they feel the actions are being taken to help them manage or perhaps mitigate any further adverse impact to the borrowers. So let's walk through here some of the highlights of the statement. The regulators have agreed as a group that banks generally do not need to categorize COVID-19 related modifications as troubled debt restructurings or TDRs, and that they will not direct the banks to automatically categorize all COVID-19 related loan mods as TDRs. So what does that mean? So a short-term modification that's made on a good faith basis to affected borrowers who are current on their loan terms, have been current. Current meaning they were less than 30 days past due at the time of the action, would not be considered TDRs. So the statement generally refers to when they say short term, they're generally talking about a 6-month period at this point. So examples of such modifications might be payment deferrals, fee waivers, extension of repayment terms, and other delays that would be considered relatively insignificant. Now, there's a section in the CARES Act, section 4013, that also specifically addresses temporary relief from troubled debt restructurings, and I wanted to spend just a minute on that. To be an eligible loan under section 4013, the loans must meet several conditions. They must have been modified because of COVID-19. The actions must be tied to a loan that was otherwise current as of the end of the year, December 31st. And the loan modification must have been executed between March 1st and the earlier of the end of this year, or 60 days after the president declares the end of the national emergency. So banks opting to account for eligible loans under Section 4013 are then not required to apply ASC 31040, which would be the normal section, right? That's FASB's normal guidelines under TDR. So if you opt for the 4013 treatment, you don't have to do the 31040. So a couple of other important things to kind of point out in this section. Banks do not have to report the if you elect 4013 loan treatment, you don't have to report those as TDRs in your call reports. So if you're familiar with the call reports, you would normally report TDRs in multiple places throughout both the bank version and the holding company version. There's a line item on Schedule RCC, there's one on RCO, there's one on RCN. They all have line items for TDR. So if you opt for treatment under 4013, you do not have to report them on the call reports. But there's a catch. The CARES Act very specifically says that banks should maintain records of the volume of loans that they make, a volume of Section 4013 loans that they make. And it goes on to say that the data about the 4013 loans may be collected for supervisory purposes, which is to say that it will be collected for supervisory purposes at some point. So that is specifically written into the CARES Act. So obviously a big part of this webinar series is to continue the conversations with all of you on how you're going to go about identifying 4013 loans, identifying PPP loans, and other maybe new or unique reporting needs that you'll have, and start to discuss and possibly share what emerging best practices are for our clients, whether you're level 3 client or vision client. I also wanted to point out a specific reference to 1 to 4 family residential mortgages because they're such a big part of your business. For risk-based capital purposes, residential mortgages that are fully secured and are current, meaning current to principal and interest, they would normally receive a 50% risk weighting. So they get a break. So you can figure that as like a 4% capital charge. But if they are restructured or modified, normally that capital charge doubles. So for most large banks, that would be a significant increase in capital requirements. But in this statement, the regulators have said that modifications to mortgages due to COVID-19 will not result in mortgages being considered restructured or modified for the risk-based capital purposes, and thus the capital charge and the risk and the weighting would stay the same. So that's really, really important, as many of your banks, in fact, have already announced plans to defer mortgage payments for affected borrowers for several months, some more than others. And so those affected mortgages are not going to have an adverse effect on the capital of the banks. Past due reporting, banks are not expected to designate loans with deferrals granted due to COVID-19 as past due strictly because of the deferral. Okay, so the loan's payment date would be governed by the date stipulated in the loan documents. So if a bank agrees to a payment deferral, this would result in no contractual payments being past due, and therefore the loan does not have to be reported as past due for call report purposes. Non-accruals and charge-offs, they talk about that a little bit. Here the regulators refer the banks to the applicable regulatory reporting instructions and their own internal accounting policies to determine if loans to stressed borrowers should be reported as non-accrual or charged off. However, they do note that during the short-term arrangements discussed in this statement, so again, generally defined as 6 months, the loans generally should not be reported as non-accrual. And then the other last point I wanted to mention, any loans that have been restructured due to COVID-19 will continue to be eligible as collateral for the Fed's discount window. Historically, this has always been there's been a stigma associated with borrowing from the discount window. the perception being that the bank must be in real trouble borrowing from the lender of last resort. But just last month, 8 of the largest banks in the country, many of you that are on the line and others have followed, they, in a kind of a coordinated effort, borrowed from the discount window in a move kind of meant to take some of the stigma away from that and help ease some strains in repo markets. So again, any loans that have been restructured due to COVID-19 can still continue to be eligible as collateral at the discount window. That's what I wanted to cover, Dean, in terms of yesterday's statement, and I'll turn it back to you.
Thanks, Doug. Appreciate that update. And what we will be doing is including this topic, these topics in future webinars and providing you even more detail, more information on the slides. Again, as you know, things are changing literally by the hour. So we are providing you updates as we get them, and we'll continue to monitor these things. So back to the PPP program, we started talking about this last week as far as new loan booking and what banks are doing. So as we've said, and as Doug just explained, there is going to be some additional reporting or ways to identify these loans. Certainly the SBA, we understand, has issued new values for some of the data types that are tracked in the loan system. Some clients are using obligation types or other standard fields, whether they be purpose code or something. Some, of course, are looking at assignment unit, which gives you the advantages of some general ledger treatment and reporting, or using like loan officer values, other organizational level fields that exist in the loan system today as a way to identify and then be able to report on these loans. One thing we're also very closely monitoring and we're working on is around the SBA reporting, specifically like the 1502 report, looking to see if, as far as I know so far, there have not been any announced changes to the 1502 report layout for now. However, the way some of these loans are being booked and also the way some of the deferrals are being done could have an impact on the way loans are reported on the 1502, especially in the interest deferral period. Again, we'll allow you, if anyone has any comments or things they want to add or updates around this area, use the raise hand feature. Renee's monitoring that, and Renee can open up your microphone if you want to add anything or if you have any other questions. And while we're doing that, I also wanted to mention, of course, we're starting to hear about staffing additions, meaning the banks are needing additional staff to deal with the larger volume of loans and the updates to the existing loans. Again, wanted to throw this question out to you of, what are you doing? Are there specific areas where you are adding staff, whether it's middle office with applications or whether it's back office and servicing things? What types of functions are you looking to augment with additional staff? So if anyone wants to weigh in on any of those topics, you're certainly welcome to do so. Moving forward to talk about the new loan booking, we of course have options for automated booking, and as we mentioned before, with AFSVision, with the new platform, there is a mass update tool, and I know several of our Vision clients are leveraging this now so that loans can actually be booked into AFS on a mass basis through automatically taking data, whether it be from spreadsheets or other sources, and converting that into the APIs that update in Vision. With the level 3 platform, of course, the options the option still exists where data can be loaded into level 3 in a traditional, we call batch card format. We know that some clients have their own tools that they've developed to connect into level 3, such as Foxtrot, that's being leveraged. And also to note that AFS does have a tool in level 3, OFTI or OFTI, right? And that was originally developed to handle large volumes of payments and financial transactions. We have the ability to leverage that OFTI tool for doing creates, such as creating new loans or updating loans. And that would require work with AFS. And we wanted to make sure our clients knew that this was a potential area for automation and efficiency. And we would recommend that if there is interest on your part to contact AFS directly so we can understand what your needs are and where we could provide some additional assistance. Okay. A couple footnotes in around level 3, just to know if you are doing some of your own mass updates on your own. Reminder about the 9,999 transaction limit for your batches. Also, in level 3, if you're doing SBA loans, and some banks use an obligor number to represent the SBA and set up guarantee references with the VSAM file structure in level 3, there are some limitations in the number of those references that you could encounter. I know there are some workarounds for those, but wanted to just remind you of what some of those current thresholds are. As you can see, it can vary depending on what release you're on. Okay. As far as manual booking options, of course, looking at adding more staff to get these loans pumped through on a manual basis. We know we have short form create transactions in level 3 for this. And then something we mentioned last week, and we've had a couple clients reach out to us about it, is to remind you or make you aware that level 3 does have a feature called product definition. I don't think it had been heavily used up to this point. It was actually developed to support some consumer type loans. And I even put here on the slide a picture of the screen. There is this screen that's available called a 13AA. And what you do behind the scenes is you build the template of the loan, what its terms are and so forth, through a series of separate screens. And then when you go to create the loans themselves for each borrower, you can do it on a single screen in as little as 10 input fields. So again, if you're facing the challenge of booking a lot of loans on a manual basis, this tool could enable you to greatly cut down on the number of keystrokes to be able to pump through more new loan volume. So again, a couple of banks have reached out to start looking at this tool. If you have some interest, let us know. We can certainly provide you more information. It may also already be in some of your standard user guide material. If it's not, again, reach out to us and we can make sure that's available to you.
Dean,
Yes.
we have a question. Molly has a question. And Molly,
Okay.
your line's open.
Hey, Dean, you said there was a 9,000 batch transaction limit, which we're aware of. Is there a guarantee limit? Can we have 30,000 loans guaranteed by the SBA with the same number?
Yeah, I went back to slide 9, and there is a bullet about that, Molly. It says if PPP loans are tied to the SBA's guarantor, there are some limitations, and it's because, again, of the VSAM file structure and number of records. Paul Elmer, I think, from level 3 is on the phone. If just to make sure I'm saying that correctly.
Sorry, I missed that one.
Yeah, that's correct, Dean. And again, it's a practice that's in place today that if you do exceed that 2,500 to 1,250 limitation, you would have to set up a second SBA obligor and start pointing the new SBA loans to that guarantor number. And again, as you get to each grouping of 2,500 or 1,250, you would have to create additional SBA obligors as needed.
Thanks, Paul. Okay,
Okay.
Molly? Yep,
Yeah, thank you.
sure. Was there another question, Renee?
Not as of yet.
Okay. And again, under the deferments we mentioned before, certainly changes to credit bureau, and we're hearing that now that the credit bureaus are setting up some new codes for that. I know there are several AFS banks that use our credit bureau module. So if you have any updates or questions, let us know. We can let you know what we've heard up to this point. Kim, yes.
I was going to say, we have a question from Kim.
So I also wrote it down if you don't have an answer right away. We're going to be using an obligation type of 351. We already forwarded this to Bob. Just if you could put it on your radar to get back to us as soon as you get an answer. For the new SBA product, then it's not going to include an FTA servicing percentage to pay to Colson. So do we only enter the GP number? Because currently the approval date automatically calculates FTA servicing percentage. And you may not have an answer to this, but how will the SBA know this is the new PPP product, which is eligible for fees paid to the lender and debt forgiveness?
Let's see. I'm trying to think who we have on the phone from AFS that might be working on that. Kim, we might need to get back to you on that.
I figured that's okay, but I just wanted to put it on the
good
radar.
Question. No, that's exactly. I appreciate the question. That's what one of the reasons we're doing these calls is provide a forum for that, and we can, as we get updates, what we're hearing, we'll send it out to everybody and look for validation that you're hearing the same thing. Okay. We did. Yes.
It's Chris, and just for Kim's question, we've got that into our team, so we'll get an answer out to you and to the bank, and we're working on that.
Good. Okay, good. Yeah, also, as we talked before about the second bullet here, using an additional charge code for tracking deferred interest, we are running through some tests now to know what happens with the 1502 report. If you're using AFS's, what we generate, what's the impact if there's two interest charge codes? So we are looking at that and see if there's going to require any coding adjustments. Again, marking deferrals, as Kim mentioned already, we'll be following up to see what's happening there. And I added on here about the fraud checks because I don't remember if we talked last week, but I'm hearing stories from personal contacts of small business owners where they might be applying to multiple institutions just to see where they can get the money the fastest. I think the SBA is trying to manage the duplicate loan request by the issuance of the SBA number to do that. And certainly KYC efforts are, of course, another issue. We're hearing, that some banks, of course, this makes the news to where they say, well, they're starting by offering loans just to existing loan customers. And I think that makes sense because for one reason, just for KYC efforts, if you already have an existing relationship, you have that done already. But if not, of course, the banks are going to be faced with going through that. So, okay.
Dean, we have a question.
Yes.
What's the impact if you use repay 5 neg amortization? Sorry.
Yes. So I think if they say the impact on SBA reporting, I assume that is something that we are testing now. I don't know, Rich, put you on the spot. Do we have any update yet on what we're seeing around repay 5?
No, we're still in the process of working through that.
Okay. Tom, do you have a question? No? Okay. Also wanted to mention, I'm going to let Doug Skinner talk again. We had, from the AFS Business Intelligence Group, they have issued a news article here relative to the recent borrowing activity. So Doug, do you want to take a minute to go through this?
Sure, Dean. Be happy to. So it looks like there's a live link here, and if not, you can certainly ask us, and we could send it along. But another part of our business is to track and report on pricing characteristics of the loans that banks make, volume, risk ratings, and that sort of a thing. And what this statement was designed to do is point out really what we saw in just the last month of March, which was a historically significant month in terms of loan growth. So just to give you some context, in October of 2008, which I was in the lead up to the Lehman bankruptcy and all the dislocation in the market, that was one of the largest growths in commercial lending in U.S. history. Loans were up 40%, I believe, in the month of October alone. And after that, they kind of quickly retreated for lots of reasons. Last month, C&I lending nationally was up 200% on an annualized basis. So that's about $400 billion in growth. Now, the vast majority of it would have been from existing syndicated lines of credit. And all this is public information. General Motors, 16 billion, Boeing, 14 billion, Walt Disney, 8 billion. So again, now, whatever that is, 30 years later, a lot of the banks, or a lot of these companies rather, are a lot bigger. The banks are a lot bigger too. And they were all really stockpiling cash and bracing for what are certain to be disruptions in their cash flow. So we have an awful lot of historical information that kind of shows banks how markets have responded to previous shocks, whether they were the Great Recession or energy spikes or whatnot. And any comparative data that you need, we'd be happy to share that with you. One other significant data point is line of credit utilization rates. They usually don't move around a lot, but they jumped 9%, meaning from around the high 30s to the high 40s just in that month alone. And with all the other government lending programs that are coming online, right? So PPP wasn't live yet. The Fed's Main Street program is not live yet. These are certainly posed to further boost the flow of credit as well. So we look forward to continuing to report to you on that in the weeks and months to come. Thanks, Dean.
Thanks, Doug. And you mentioned the Main Street Lending Program, and we do have that on our list as a topic for next week, where I think the Fed's going to be opening up even additional channels for lending. So we'll be covering that. We'll continue to provide updates from Doug on the 4013 details, talk more about call reports. I guess one benefit of this happening in early April is we've got a little bit of time before the next quarter ends, but certainly we'll have to be watching closely what kind of reporting is going to be required at that point. Are there any other questions before I start wrapping up today? Again, we will have our next webinar at the same time next week, April 15th at 1 p.m. We hope this is beneficial to you. We appreciate everybody's listening. And as always from AFS, we hope that everyone stays safe and stays well. Thank you very much.